So the point here really is that there's a big shift that's happened.
So this is the pig which is inside the python.
That's right.
The python is the world going on.
That's right. So there's a big change which is taking its time to have an effect, and we've not seen the full effect yet.
So the full digestion of a pig and a python will take a very, very long time.
That's right. So without stretching this too far, what we're really trying to say is, look, you've gone from a period of free money that's lasted a long time. People have gotten used to that free money, and that's affected their spending habits, how they funded their spending. It's affected how much money they've borrowed to own assets. It's affected how businesses have funded themselves. And now we're going through a big shift, which is going to take some time to ripple through as the refinancing works its way out. And so what we can't tell right now is exactly who's been lending the money to people they shouldn't have lent it to, and who's borrowed money that they couldn't afford to borrow. Because, and this is a really key point, the banking system, under the too big to fail limits after the GFC, really prevented the banks from lending very speculatively in the way they had in the run-up to the GFC. And there were some exceptions to that for the banks that were operating below the level that was set as the cut-off for too big to fail. That in itself is another whole story, because all the bank failures we've been talking about, ironically, are partly a result of the renegotiation of those too big to fail definitions, which were originally 250 billion of assets, but in 2018 negotiated down to 50 billion, partly led by folks like the then lead of Silicon Valley Bank.
I've got another analogy. It's like a blockbuster movie. I don't know, what's one of ours? Fast and Furious, NBC Universal movie. Franchise. Very successful. So it's like the car crash has happened, yeah, and then suddenly the car is tumbling over in slow motion. They've slowed the whole thing, and we just don't know. It's almost like we expected in financial markets a real-time reaction. We haven't got it. So it's going to take a long time before people actually realise. You said people's spending habits have changed. You said corporates' financeability has changed. Do they know it? Because I don't think some of them have realised what's this tsunami that's going to happen when we go back to real time and with the car rolling and rolling and rolling.
Well, as is always the case, I think people who are mindful of these things will have made the most of the free money, will have borrowed the money for as long a period as possible, and will have thought carefully about their wall of refinancing, so that they've exploited the cheap money, but have a sufficient path forward to being able to deal with a reversion in rates. But that's not everyone, and so I think for creditors and for investors, and the link I'm going to make here is for mum and dad investors and advisors. For a long period of time, what did cheap money mean? It meant that you could just take risk and you'd be rewarded for doing it. You could ride momentum. You didn't really have to think about diversification in portfolios. You just jumped on the bandwagon. And what that meant was people were anointed as great investors who were really just following momentum and didn't think about diversification.
The great story is man who buys house in 1988, Howard as a financial guru. Isn't that the one, I think?